This is Pranav Rao from Smartkarma, and I'm pleased to have with me today Manishi Raychaudhuri to discuss his approach to picking Indian mid-caps. Manishi, thank you for your time today on the 29th of July.
Thank you. Thank you very much.
Could you briefly explain the methodology you detailed in your Smartkarma insight on how you're selecting Indian mid-caps?
Absolutely. When investors look at mid caps, they potentially try to identify the large caps of tomorrow. So it is important to consider not only the earnings growth projections of the mid caps, but also the kind of valuations that they are trading at. It has to be quality growth at reasonable price. That is why we screen the mid caps, which are essentially $1 billion to $5 billion in market cap. Firstly, on future earnings growth forecasts, that is about 10% CAGR over the next 2 to 3 years. And secondly, on a price earnings to growth multiple of at most 1.3 times. Now, this PEG multiple is slightly higher than what one would choose for the large caps, because the mid caps tend to be relatively high growth companies growing from a low base, and therefore they tend to trade at higher premium. So that's the basic framework. Now, at the same time, one has to avoid falling into the trap of, kind of value traps where the earnings estimates are declining, and therefore what's cheap today might appear expensive tomorrow. To avoid that, we consider only those companies which are currently in a situation of getting their earnings upgraded over the past 6 months. The assumption here is that the past 6 months, which were the most uncertain period in recent history, if the earnings are getting upgraded during that time, the earnings estimates are relatively robust. Third, these quantitative screens also tend to ignore some of the softer or qualitative aspects, like corporate governance, like quality of the management. And that is why we also look at only those companies which have either a strong buy or a strong overweight recommendation attached to them, and we choose the FactSet consensus recommendations for that purpose. So this is basically the framework. It's kind of a three-pronged approach that we have in selecting the mid caps, and fortunately that has stood us in good stead.
Understood. And I think, Manishi, you first published about this on Smartkarma in February 2025. How has that initial basket performed since then?
We published our first basket on Indian mid-caps in February 27th, 2025, as you rightly pointed out. Over the next 5 months till late July, this basket, and we constructed an equally weighted basket of the 20 mid-caps that we identified. This basket generated a return of 29.4%, which was significantly higher than the approximately 20%, I think 20.6% return that the Indian BSE mid-cap index generated during the same time frame. What's even more important is the breadth of the success rate. Out of the 20 companies that we had selected, only 2 actually declined during this time period. The remaining 18 actually moved up, and out of those 18, 15 moved up significantly more than the BSE mid-cap index. So the breadth of alpha generation and the breadth of outperformance was very significant following this approach.
Interesting. Thank you for that. In your view, Manishi, what might some of the drawbacks be of selecting companies in this fashion?
Now, the risks usually are twofold: the risk of omission and the risk of commission. The risk of omission, which is omitting a potentially very successful mid-cap, arises from the ones which are potentially turnaround stories. Suppose a company is generating losses today, but is likely to turn around and generate profits going forward. Those are actually the strongest stories, but they tend to get screened out by this quantitative approach that we follow. Second, and I would now concentrate on the error of commission here, committing to stocks which are not really that good in the basket. They usually arise from the possibility of wrong or stale estimates. Sometimes these consensus estimates that we follow, they tend to be not quite revised in a timely basis by the analysts who are doing that. Now, it's possible to minimize this risk, but it's not totally possible to eliminate it. To minimize this risk, we actually look at companies which are well covered, at least by about 5 to 7 analysts 5 to 7 reputed analysts. We also look at estimates which are regularly being updated. But at the same time, the risk remains to some extent. I will focus on one last aspect. Very frequently, these mid-cap, super performers, in a sense, they fit into certain narratives or certain themes which are specific to a market, which are specific to a geography. So it is important to have a thematic or structural overlay as well, which we did. We looked at when we put out our first report in February. We looked at the 4 or 5 themes which are currently in vogue in India, like industrials and defense, like penetration of organized sector financials, like banks, and also the affluent consumption, which kind of comes into not only consumer discretionaries but also healthcare in terms of the diagnostics and the hospital chains. So it is, sometimes it's important to have that qualitative thematic overlay on top of the quantitative approach also.
Very interesting, Manishi. Thanks very much for the call today. And listeners,
Thank
do
you.
check out Manishi's coverage of Asian equity strategy on Smartkarma, and please tune into our next Smart Call. Thank you.
Thank you.